Okay, Dr. Payne here again. This time we're going to look at the statement of cash flows. And I have a statement of cash flows on the whiteboard here. Um, at the top we have statement of cash flows. This statement also is for a period of time. So we have for the year ended 12/31/X. So this is for 1 year, all the transactions for 1 year. And this statement has 3 sections. Cash flows from operating activities, cash flows from long-term investing activities, and cash flows from financing activities. So what we're doing is we're basically where the income statement is on accrual basis. And what that means is in accrual basis, revenues are recorded as they're earned, not when they are received. Expenses are recorded as they're incurred, not as they're paid. So in order to show cash, we have to do a conversion from net income on accrual basis, which is important because we can see how much money we actually made during the period, matching, putting the revenue in the correct period when it was earned and matching the expenses in the correct period with that revenue. So the net income figure is important, but it's not cash. So in order to show what actually happened to the cash, we need a cash flow statement. So we start out with net income, so we could trace that back to the income statement. We see where that number comes from. But then we have to add back certain elements or subtract elements in order to come up with cash flows from operating activities. So here we have net income. And then, as I said in the previous video, depreciation is an estimate of the using up of a fixed asset. It's not an outlay of cash. So, and likewise, amortization. So if we'd had amortization on this income statement, we would have had to added it back here too because it's just an expense, but it's not an outlay of cash. So in order to calculate how much cash was derived from operating activities, we would take net income and add those non-cash expenses back. By the same token, accounts payable, in this case, accounts payable went up for the period. So what that means is that we incurred more expenses which are deducted from the net income, but we didn't pay them yet. Okay, so those expenses are deducted from net income, but not yet paid. So if the accounts payable figure went up, that's actually needs to be added back to net income to calculate how much cash was available. Same thing, accruals. Our accruals from the beginning of the year to the end of the year increased. So we have expenses that have been deducted from net income, but they've not been paid yet. So therefore, they're not an outlay of cash. In order to get the cash figure, we have to add that back to net income. Increase in accounts receivable. If accounts receivable went up, that means that we have revenue included in net income that we have not collected. So in order to get from net income down to the collections of accounts receivable, we would have to reduce it by that figure. By the same token, if accounts receivable had decreased, we would add it. Same thing with if the accruals had decreased, we would subtract it. If accounts payable had decreased, we would subtract it. Okay, so it depends on that account's effect on cash. So what we do is we look at all the current assets and liabilities and determine their effect on cash and put them in that operating section. Also, inventory. Inventory increased. If inventory increased, then we must have used cash to buy it, but it's not included as an expense. So we have to deduct that from net income in order to calculate the actual cash outlay of during the period for inventory. Okay, so when we add all that together, we end up with a net cash flows from operating activities of 23. Then the next section, cash flows from long-term investing activities. So what we did there was we purchased some fixed assets. So obviously that's a use of cash, so that's going to be a negative number. If we had sold some long-term assets, that could have been a source of cash. We would have had a sale of fixed asset and added that in, and that would have been a positive number. Then we have cash flows from financing activities. We have an increase in notes payable, so we must have borrowed some money. So that's important for financial statement users to know that the company borrowed money during the period. So you have to think, okay, what did we do with it? Well, we did buy some fixed assets, so that's probably one thing that we did with the monies. Also, we had an increase in long-term bonds. So that's a source of cash. We had a dividend payment. So we paid monies out to stockholders. So that is a use of cash. So that's got brackets around it. That's how we use some of the money. Now, if we paid down some notes, that would be a negative number. But we didn't pay down, we borrowed monies. And that's important to see. So our net cash flows from financing activities is a positive 12. Now, if we had issued stock, same thing, it would go in this section. So increase in cash from a stock issue. So then we have our three sections. So we have our net change in cash. We had income or cash from operating activities of 23. We used 45 to buy fixed assets. And then we had cash from financing activities of 12. So we had a net decrease in cash for this year. Then we put our cash at the beginning of the year was 20. So then we calculate if we had a reduction of 10, we had a beginning balance of 20. So our ending cash is 10, and that number will balance to the number for cash that's on the balance sheet. So that's our basic statement of cash flows.